Welcome back, everybody, to the Informed Home Buyer Podcast. My name is Rich Curtis. I'm your host, and I have my co-host with me, as usual, Dave Miller. How's it going, Dave?
Good, Rich. Thanks for having me.
All right, we have a big show for you guys today. A lot to cover because there is a lot going on. Trump just announced all of the new tariffs yesterday. The market is already responding. So we're going to go through it for you. How do these tariffs work? How are they hitting the housing industry? Are they going to create new jobs? Are they going to bring money here, send money away? How's it going to affect inventory? How's it going to affect mortgage rates? How's it going to affect you at home? And how do you change or not change your home purchase decisions based on what's going on in the world right now? And we have a lot of talk, a lot of banter going on in the media and the marketplace about what Dave in a previous podcast was calling the R word. And we should clarify, when Dave says the R word on this podcast, he's talking about recession, not the other R word. And so Mark Zandi, chief economist of Moody's, says if they follow through with these tariffs, I'd buckle up and brace for impact. A recession seems more likely than not. And that's just one of many economists on both sides of the political spectrum, red and blue, that agree that what's going on right now in the market is, to use a kind word, bananas, and leading us down a bad path. So we're going to get into that. Let's start with the new tariffs, what they did and didn't do. So one of the great things here is he didn't do new tariffs that affect the building industry. He carved out things like Canadian lumber, gypsum from Canada, and those things. So those are still subject to the original tariffs.
Yeah. Hey, Rich. And I think before you dive into this, for folks that are new, maybe just 10 seconds, 20 seconds, what a tariff is.
Oh, yeah. Good call. Yeah. If you haven't been watching every episode, you should. But if you haven't been, let's clarify. There's a lot of misinformation about what a tariff is out there. A tariff is a tax, an import tax. And when people from the Trump administration say that the foreign countries are paying these tariffs, that is an outright provable lie. Never in the history of ever has a foreign country paid a tariff in the United States, and never will they ever. So here's how it works. If I own Acme Steel, a US steel company, and I'm importing steel from China, as that steel hits the port in the United States and I go down there to take possession of it to go build whatever I build out of steel, if Trump has put on a 10% tariff, then it costs me 10% more. If Trump's put on a 25% tariff, then it costs me 25% more to get that steel out of hock at the port and get it on my trucks and take it to my factory to do what I want to do. So tariffs are a tax on the American people. They are driving up the cost of goods, and the American company pays that tariff. Now, the steel goes to the Acme Steel plant, and the CEO and CFO of Acme Steel sit down around the conference room table, and they have a decision to make. It just cost us 10% more for that steel. Are we going to eat that and have our profit margin go down by 10%? Or are we going to increase the cost of our goods that we sell to the American people? And I think you can all pretty much figure out which decision they make 100% of the time. So these tariffs all result on the cost of goods and services, in some cases going up for the American people. So sorry to say, there's a lot of misinformation about that. That's how it really works. Now, Trump had already done 25% on Canada and Mexico, and those are still in place. So those did drive up the cost of lumber. We get like 70% of our dimensional lumber from Canada, or pardon me, 30% of our dimensional lumber from Canada, and about 70% of our gypsum from Mexico. So the cost of construction goods had already gone up. In this new round of tariffs, he carved those things out and said no more tariffs on those. So dollar for dollar, this won't exactly hit the building industry. But Dave, you had shared an article with me. Maybe you can talk about, even when the original tariffs went on and then got paused, people were already starting to charge more for, plumbing parts and everything in the construction industry. It already had the cost had already been starting to be passed on to the consumer, even when the tariffs were paused. Is that what you were finding?
Yeah, I think that's almost always the case, that when we're talking about things transpiring in the market, whether that's, the Fed's lowering rates, whether it's tariffs, whether it's taxes, that oftentimes gets pre-baked in. And so we're already seeing companies hedge and raise their prices because they don't want to be stuck holding the bag.
Yeah.
Tariffs have come on and off, and there's been a pause. And, for anyone that's selling anything that needs to procure it internationally, they don't want to, again, they don't want to be stuck with that increased cost. So they already, and one of the things that I think we tend to experience is when those costs go up, even when the tariffs go away, those costs don't necessarily go down instantaneously, right? Like
In fact, in most cases, they don't ever come
they don't
down
ever.
at all.
Right. Yes. And so, again, these are inflationary challenges. So we're in inflationary position right now where the Feds have been pausing to lower rates because they're managing inflation. But these tariffs and the cost of the goods that are coming in is only inflationary measures. Those are everything that we're doing typically causes inflation, not the other way around.
Yeah,
So,
I think, and we are going to get to the downstream effects on the housing market, but I think one of the things that allows this misinformation, allows people to go out on TV and say foreign countries are going to pay the tariffs, which is an outright lie, is that all of us everyday Americans, who the hell knows how tariffs work? Who knows how international trade works? Who knows how the manufacturing industry works? We don't need to know these things. We don't know these things. We don't follow these things because usually you can disagree with what people are doing, in the economy and in politics, but usually there's at least a relatively measured hand at the tiller, at the steering wheel, where we don't see big swings in these things. And when we don't see big swings, we don't care how they work. But these things, the stated impact of these things, there's two things. He says he's going to bring more jobs back to the US. So that's not going to happen. Head of the auto industry has already said, similar to the head of the lumber and wood industry, that it takes us 3 to 5 years to bring a new plant online. So from today, if they decided, well, we're going to onshore all of our auto production, it would take 3 to 5 years for a new factory to come into existence here.
and
They've
and
also,
not and to that point, Rich, not only that, the cost to build that plant, and Trump may, we're looking at 3.5 to 4 years left. Do you want to do this huge capital expenditure when potentially these tariffs will either come down, go away, or a new administration might come in and do away with them or reduce them quite a bit? So now you're left holding the bag with plants and facilities and capital expenditures that you maybe didn't need to spend.
right, because the political winds could shift back the other way. One of the sort of dysfunctions in our political environment is that we tend to just throw the baby out with the bathwater. If you disagree with Trump or Obama or Biden, broken clock's right at least twice a day. But we tend to, when the new guy comes in, throw out everything the last guy did for political means, to whip everybody into a fervor, to pretend like everything that guy did was corrupt and terrible, and I have to fix it all. We throw out the good with the bad. And when the next guy comes in, if they are antithetical to Trump's position on this, it could swing right back the other way. And if you're an American auto plant that just dumped, millions or billions into building new factories, you are absolutely left holding the bag in what could be an industry-ending way. And who's going to take that chance? Also, all these things, all this offshoring started with NAFTA back in the 90s, went into effect in 1994. And we started this open trade with Canada and Mexico. And we started moving factories to Canada and Mexico. And maybe if we had come back in 1996 or 1997 and said, oops, our bad, we lost a lot of jobs, let's bring the factories back, we would have had a lot of union jobs come back with those factories. But it is not 1995 anymore. It is 2025. Go online, pull up a video of a Tesla gigafactory and see who's making the cars. It's not union auto workers, it's robots, right? Robots aren't science fiction anymore. They are here, they are efficient. And the head of the US Automakers Association has said, if we have to build US factories, if we have to dump all that money in, it makes no sense to build an antiquated auto worker run factory. We're going to build factories with robots, and there just aren't going to be more union jobs coming back. This is a sad thing that happened to our country. It is a problem. There are people to blame for it, but there's not a solution. We are not going to see large-scale manufacturing return to the United States, no matter what we do here. For those reasons you mentioned, it's a risk because the political winds could shift. And even if we do, we're going to do it in a much more cost-effective manner that leverages, robots and AI, and not humans building cars the way they used to. I hate saying it out loud. It hurts my stomach to say it, but that's the reality of the world we live in. Second rationale before we jump into housing is, Trump is constantly wanting to try to get rid of income tax, right? So one of the stated reasons for all this to replace income tax with tariffs. and he pretends like he's going to get that money from other countries. But as we just mentioned, it's coming from you and I. Tariffs equal taxes. So the IRS took in last year $2.96 trillion in income tax. That's what they collected. We imported 3.3 trillion in goods from other countries. Now note that those numbers are very, very close. 2.96, 3.3. In order to replace income tax with tariffs, you'd have to have a 100% or greater tariff on everything coming into the country. Again, this isn't politics, it's math. Math isn't Democrat or Republican. It's just math. It's not possible to replace income tax with tariffs. At best, the Trump administration's projections are that they'll bring in $600 billion in new tariffs. Now, that's $600 billion out of your pocket and my pocket, which means these tariffs represent the single largest tax hike on the American people in recorded history. With your own politics, you do with that information what you want, but that's the math. That's what we're facing. So we're not going to be onshoring new jobs for American workers, and we're not going to be replacing or getting rid of income tax. And we are going to be spending a lot more money out of our pockets for everything we need every day for our families. That's what's going on. So let's talk about how that's going to affect the housing market. And right away, people's first thing that they lean into is interest rates. What's going on with interest rates? And here, that was a little doom and gloom there. Here we have maybe a bright point in all of this. Dave, what's gone on? We saw a massive stock market insanity today. Dow off 1,200 points. We're down 3.5 to 5% between the Dow, the NASDAQ, the S&P 500, depending on which one you look at. How's that affecting our mortgage rates?
Yeah, it's a good point, Rich. And so historically, if we've done these, we've talked about, okay, what's the Fed doing? Is the Fed going to come out and lower rates? And we're waiting for that for the bond market to improve, the 30-year mortgage-backed security to improve, which makes mortgage interest rates go down. We've been kind of waiting for that to happen because there hasn't been any other economical forces that have caused the bond market to improve or interest rates to come down. And also historically, when the stock market was, not having a great day, money would move from stocks to bonds, and that would help the bond market, and we'd see interest rate. We weren't seeing that correlation either. But today we saw a fairly significant increase in the bond market, which meant, maybe you want to share this chart. I got a bond chart here, Rich, which will show that we are up. Last I looked here, let me see, we were up 38 basis points on the day, and I'm going to give it real time here. Yeah, we're still up, and it looks like 38 basis points. So if you look all the way to the right there, that green box is showing where we're at, and this is a quarterly chart. So if we go back here, and I'm back to December, we're in a pretty good position here when you look at that bond graph. So we are looking at 99 point, what's that number looking like here? We are at 99, which we're over a floor of support. So over 99.5, which means that we should expect to see interest rates hold steady or even continue to improve a bit. What does this mean for the consumer? Yeah, rates have improved by 1/8 of a point. We're still on average, we're in the mid to high 6% range for most folks. Obviously there's caveats there with credit score and income type and LTV and all that good stuff. But for the most part, we're sub 7, but we're still above 6.5, but we're trending in the right direction. And so, this is good for the folks that are interested in potentially buying a home, or folks that bought in the last couple of years and maybe have an interest rate over 7.5%, there's an opportunity to refinance. But what you've talked about, Rich, here is what we call, the acronym might be FUD, fear, uncertainty, and doubt. Interest rates are getting better, but I don't think we're necessarily seeing this mass, population come into us saying, I really want to buy a house now. Rates are improving. I need to do it right now, because they're worried about other things. They're worried about being able to pay the bills. They're worried about, seeing their 401ks go down by, 10, 15%. It's scary, even though that's not money they're going to touch for sometimes 20, 30, 40 years. It just doesn't feel good. There's some fear associated with that. Or if maybe your down payment monies have been in the market and you had enough for 5 or 10% to put down, and now that's down by 15%. That's limits your purchasing power. So, but they're still, for the right person, for the right individual. We're not trying to spin, or this is not everything's always doom and gloom. The opportunities created for a lot of folks.
Yeah.
Can we tell you what the future is going to hold in 3 months, 6 months, 9 months? No, but we can tell you what the data is showing us.
Yeah, and I think that's a good segue into what are the numbers showing us? We talked at the opening of the show that there are some cracks showing in the housing market. So, and these cracks showing in the housing market sounds a little negative, but in terms of affordability and some impact on people buying a house right now, there could be a little bit of good news there, like you say. Sometimes these economic downturns do create opportunity for a well-capitalized buyer with secure employment and all of that. And to that end, again, there's a lot of fear, there's a lot of noise, there's a lot of information to take in. We're throwing a lot of information at you in this podcast. It is high level, like macroeconomic information that the average person shouldn't have to consume on a regular basis when it's not so chaotic as it is now. A couple of pods ago, we did one that was on sort of the 5 fundamentals that make you a good buyer in any market, regardless of what's going on. Go back and watch that. If you meet those 5 fundamentals, then lower interest rates and potentially lowering, prices makes this an opportunity for you. And if you don't meet those 5 criteria, and you're more sort of on the ragged edge of affordability or of economic stability or of job stability, then this really is a time for you to sit on the fence. And let's go to the national numbers now and see how are people feeling. We are in a confidence-based market. And what that means is how people are feeling has a greater effect on the economy often than what we are doing. The tariffs are having a negative effect on the economy and are going to continue to do so. But what will really tank us into a recession is what Dave talked about, the FUD, the fear and uncertainty going around the tariffs. And we are starting to see some cracks in the housing market around that uncertainty. So like we said, you might have uncertainty about watching your 401k plummet. You might have been planning to take a loan from your 401k to help you with your housing purchase because you hadn't saved enough money for your down payment costs. We have podcasts on how to do that. But, we were down 10% before this recent round of tariffs, on the year on the stock market. We're, like I said, 3.5% to 5%, depending on which index you're looking at today. You could be down anywhere 12 to 15% overall on the money you have in the market. And that's if you're only just invested in just straight up sort of market tracking index funds. If you were picking individual stocks, depending on the sector, you might have gotten slaughtered even worse. If you had your down payment in the market, the money, we often use 500 grand as a average purchase price on this show, which leaves you needing 3% for down payment, 3% for closing costs. That's 30 grand. If you drop 15% off that 30 grand, now you've got 22 grand. And now you have to go out and save up another 8,000 or get another 8,000 somewhere to make your housing purchase. So that's affecting people. Fear of job loss is affecting people. Fear of more tariffs. If this administration come out and just done a blanket 25% tariff, here it is, it's going to be in place for a year, 2 years, 3 years. We could all respond and deal with it. But right now it's on again, off again, new tariffs all the time. It's that chaos that's making people afraid. So how's that affecting the market? Well, last year was the slowest existing home sales in the market since 1995. So last year, volume-wise, was a bad year in real estate. That was because of the lock-in effect of those, 2.5%, 3.5% interest rates, not enough volume on the market. So it was purely a supply and demand driver. So what are we looking for to fix that? More supply. Well, ironically, now we have more supply. March year over year is up 17% in terms of supply, new listings on the market. So we have 10%, up 10% year over year. So we have 10% more listings on the market this March than last March. So the supply is easing. However, we are 5% down, 5.2% to be specific, in pending sales. So we have 10% more homes on the market, which is what was keeping the sales volume low. But we've now gone down an additional 5.2% in terms of pending sales. And the only reason for that is this uncertainty. You see, mortgage rates are actually better, a tick better. We've seen, I think, on average, about an eighth, Dave, would you say better because of this new tariff announcement?
Yeah, I would say overnight we're seeing, correct. And with this bond market movement and what we're seeing in the 10-year treasury, we are about an eighth better in interest rate on average.
And year over year, we're probably close to a half better. I mean, we were in the 7s last year.
Yeah,
For a chunk of it.
and what does that eighth mean for most folks? And we use a 500,000 purchase price as our baseline or loan amount. You're probably looking at that eighth probably equates to $40 a month, 40 to $50 a month. So not enough to move the needle. Psychologically, though, again, lower the rate, the better for me as the consumer. But again, shouldn't make or break whether you now decide to buy or not. If you've met the fundamentals and it's time to buy, that the rate landscape is what it is. If it gets better, future potentially refinance, but known commodity now, an eighth or quarter better isn't going to make it, such that you are now all of a sudden buying your dream home.
Yeah. So now interest rates are the same or better. Inventory's up 10%. We are starting to see another sort of crack in the market. We're starting to see price reductions. In March, 17% of active listings nationwide had done at least one price reduction. So we're starting to see price reductions. We have interest rates being lower. We have inventory being up. These are all signs that in a traditional market, Dave and I would look at and say, hey, sales volume is going to go where, Dave?
Sales volume is going to increase,
Yeah.
yes,
Yeah, go up. It's going to get better.
100%. Yeah. Yes.
Those are all good signs in our
Yeah.
business, yet sales are down 5.2% on pending homes. And that is because of all this fear and uncertainty in the market. So what does this mean for you as someone looking to buy a home right now? It means you have to go back, watch that episode on the 5 fundamentals and assess for yourself. Do you have stable employment? Do you have an emergency fund? Can you make the payments as they are now? Are you going to have a long-term time horizon? The house you buy now, you're going to keep for 5 to 10 years. You have to assess whether you fall into that category of what would make a good, solid, safe buyer for now and kind of block out all the noise. And if you don't meet those criteria, then this uncertainty means for you, it might be time to sit on the fence. And I think of those, that 5.2% reduction means that there's so much uncertainty, so much noise, and people don't know how to make a decision. So everybody's backing off and getting on the fence.
Yeah.
And what I would say to a lot of you, Warren Buffett said during the Great Recession, if I had a way to buy up 100,000 single family homes right now, I would do it at these interest rates. This is the best opportunity to buy a home in our lifetime. And yet most people weren't buying homes because of all that fear and uncertainty and job loss and all that stuff. And so he started Berkshire Hathaway real estate brokerage so he could at least get a piece of the pie that way, because he couldn't figure out how to hold and transfer that many homes. For you, if you have backed off because of all the fear and uncertainty, I really recommend watching that other podcast, because for a certain percentage of you, this is going to be one of the best windows of time to buy a home that we've seen in the last 5 years. And for a lot of you, if you don't meet those criteria, this means it might be time to pump the brakes and back off.
Right.
Because I don't think the uncertainty's over yet.
Yeah. And I don't think so either. But also, we need to clarify here. There's 2 things I want to clarify. A, you and I aren't trying to spread doom and gloom. You and I don't get compensated unless people buy a home or do a loan.
Right.
So we're not trying to turn folks away. We're just trying to spread the information that, because this is what we do, this is what we specialize in, share the knowledge there. The other thing is, we just saw an 8% improvement in interest rates. If you're seeing this tariff and what Rich is talking about in terms of inventory increasing, don't say, oh, well, things are getting a lot better, I'm going to now wait 6 months and get a 5% interest rate and buy that house for $100,000 less than it is today. We can't predict the future. I don't think that's going to happen. We're not advising that you do that. We're not, and so if you're someone, and we've seen this, and Rich, we've talked about this for the last 5 years, people that have sat on the fence because they thought things were going to get better. And how'd that work out for them? Right.
Or clients, when, there was a lot of signs before COVID of a market adjustment. We thought the market was going to come down. And so there were buyers who were thinking about buying investment property, 2018, 2019, and maybe pump the brakes. So they thought, oh, it's about to crash. And there was signs that correction was going to happen. Then COVID happened, everything went through the roof and they missed their shot. So the reason you should pump the brakes right now is not because of the uncertainty and insanity coming out of Washington. The reason you should pump the brakes is because you're not a qualified buyer. And the reason you should move forward is not to try to grab some opportunity and time the market. It's because you're a qualified buyer and you want to own a house right now. And that's why we refer back to that podcast about the fundamentals, because what allows you to make good decisions is kind of blocking out all the noise and assessing yourself and your own financial position. People in a strong financial position right now who have, recession-proof employment and, spare cash on hand and emergency fund, they can buy stocks today while the Dow's down 5% and get a good deal. Same in the housing market. And if you are in an industry, if you're a federal worker right now, maybe not the time to buy a house, right? You probably don't feel like you have stable employment. And so it's really what saves you and allows you to build wealth when everything gets insane like this is self-reflection and self-assessment about your own economic position, not getting buffeted by the insane winds of what's going on out there in the economy and in the media. So,
yep, well said.
I think to that end, our price is going to crash in housing. We'll cover that before we wrap here. We have already seen the price of construction materials go up. Even when tariffs were paused, they kept going up. The Building Industry Association, National Building Association, is baking in a minimum around a $6,000 to $10,000 increase on the cost of new construction. And I think that's a gross underestimate, because they're just looking at, well, if gypsum goes up this much, the price goes up this much. They're not looking at overall the cost of goods. We were just reading an article this morning about a company in New York. They provide doors to an apartment building plan. They signed a bid to provide doors at this price. They bought half the doors up front, and then we're waiting to buy the second half of the doors from Canada for the second phase. Trump slapped those original 25% tariffs, and the cost of buying those doors from Canada went up $30,000, but they had already guaranteed a price in their contract to the builder, and that company ate $30,000 on that one job alone. Now, what's that company got to do on the next job? One, they've got to increase price to try to make up for their losses. Two, they've got to think, well, he could slap another 10% or another 20% in the middle of this job. I need a hedge. I'm going to increase my prices another 10 or 15% just to try to protect myself and my business, which is a rational decision to make in this environment as a business owner. So I think we're seeing gross underestimates about how the cost increases will hit the new construction market. So even as we're seeing 17% of listings have a price reduction in March, if the price of new construction gets high enough, or the size of home goes down to where now you're paying $700,000 for a 1,400 square foot home because it costs that much to build it, people are going to shift back to the residential resale market, eat up that inventory, and there will be positive price pressure, in my opinion, there again. So we don't have a crystal ball, but I think prices rising is just as likely a scenario as prices decreasing with the chaos we have going on, and potentially, in my opinion, more likely that long-term, over the course of 12 months, prices rise rather than fall unless the economy breaks into full-on recession or depression.
So if I hear you correctly, Rich, you're saying that those home builders aren't just going to take a loss on those 6%
Right.
increase in the cost of goods. They're going to pass that on to the consumer. So 6%, which you think is low, is a $500,000 house. That's $30,000.
Yeah. Six. Well, they were predicting 6,000, not 6%. So they're saying 6 to 10,000.
6 to
But
10,000. Okay.
To your point, I think 20,000 or more is much more likely an increase in the cost of a new home.
$500,000 home goes up to 520,000. So
yeah. So could end up being a 5 or 6% increase in the cost of new construction, which then pushes people back into the residential resale market.
Right. And if
and
people in the residential
that,
resale market are sitting on 3% or 2.5% mortgages with all this fear right now, they may not be as many listings coming on board. So again, we run into a supply issue. So have to wait and see there.
Yeah. And all of this, the ultimate sort of worst of this is that sort of stagflation idea, where you have stagnating returns in the market, and you have slow economic growth, but inflation keeps going because of the tariffs. And we have sort of an analogy there in the housing market, which is where all things should be pointing towards the market breaking and prices coming down. But because of these tariff pressure, prices actually go up at the same time we have job loss and things. And so that is sort of that positive feedback loop that leads to recession and depression. Here's hoping we don't get there. Dave and I don't have a crystal ball. In a normal market, a month out prediction is about the best you can muster with any accuracy. And I think with the chaos coming out of Washington right now, we're riding the train. That we can predict what's happening right now because we can see it, and anything beyond that is speculation. And that's why your economic fundamentals matter even more in this market than they have in the past.
Right. And there could be, I don't know that, but in the next 30, 60 days, and I'm already reading, there could be a real pivot on a lot of these tariffs.
And we don't know. Yeah.
We don't know. So, it's kind of a wait and see, but that's just the environment we live in today.
Yeah. So keep an eye on this space, like this one, subscribe. we actually try to give you more evergreen content about buying houses and how to prepare for buying houses and how to get the best deal, how to be a financially sound buyer. That is the goal. But with the economic news right now, we will come back to you anytime there's big shifts like this, because it is affecting your home buying journey, and we want to give you that information. So subscribe, and we will keep you updated as things continue to unfold and as we get more data. We're purely data driven here. Like I said, it's not a politics show. We're just going to give you the numbers. You make your own choices. We are at 30 minutes. You just spent a half an hour listening to two middle-aged people in the real estate industry give you a bunch of doom and gloom. If you made it this far, you are a sadist or you are deeply committed to your financial education. And we really appreciate you giving us your precious time today. I'm Rich Curtis.
And I'm Dave Miller.
Thanks for watching, guys. We'll see you on the next one.